Let's talk about the Magnificent Seven. No, not those guys, these guys. 7 tech companies that have dominated the US stock market in recent years and delivered huge returns for investors. Such has been their success that it raises a very real concern. How long can it go on like this? And these fears have been heightened in the wake of the recent market volatility post-Trump's tariffs. Many people are comparing their rise to the dotcom bubble, which saw the meteoric rise of newfangled internet companies, only for the bubble to burst in the early 2000s, causing a lot of pain for a lot of investors. The similarities are alarming, but is what we're seeing today really the same thing? I've seen dozens of market panic attacks in my time as a professional financial planner, so I've gotten pretty good at spotting the difference between normal volatility and a genuine crisis. So in this video, I'm going to show you how the Magnificent Seven stacks up to the dot-com era, figure out whether this is another bubble ready to burst, and share the investment strategy I use with my clients for minimizing risk in uncertain times. In the late 1990s, the rise of the internet led to a stock market boom, especially in tech companies known as the dot-coms. Investors were eager to get in on this new frontier, pouring money into tech startups faster than you could sing Ice Ice Baby. The hype created a massive stock bubble, with prices skyrocketing well beyond their actual value. However, by the year 2000, reality set in. Many dot-com companies failed to deliver on their promises. They actually had little to no profit, and investor confidence plummeted. The bubble burst, causing stock prices to collapse. The Nasdaq, which had heavily tracked tech stocks, lost almost 80% of its value by 2002, leading to widespread losses and a recession. The dot-com crash marked the end of the internet stock bubble and reshaped the way investors approached tech stocks, leading to more cautious investing in the years that followed. And yet here we are, staring at the Magnificent Seven with an unsettling sense of déjà vu. But let's see what the numbers tell us. The S&P 500 performed very well from the end of 2015 through to 2024, with an overall return of over 178%. However, it doesn't come close to the Magnificent Seven, which have a staggering 697% combined return over that same time span. It would be fair to say these 7 companies have really driven the performance of this index and dragged the other 493 kicking and screaming behind them. By way of a comparison, here are 7 of the biggest companies back in the year 2000 as the tech bubble leaders, compared with the new Mag 7 here. Microsoft makes an appearance on both lists, but they are the only survivor. The aggregate market cap of the 7 tech bubble companies in March 2000 was 19%. That's to say, the value of these 7 companies combined made up 19% of the whole US stock market. As at September 2024, the Mag 7 made up over 31% of the US market. In other words, this concentration risk has almost doubled, which on the face of it looks pretty startling. More of the US market is made up of the success of 7 companies alone than during the dot-com bubble era, and we all know how that ended. However, take a deeper look and you'll quickly realise there's a lot more to this. Let's have a look at their cash positions. Liquid cash is often a good measure of how stable a business is. Back in 2000, the aggregate cash position of the 7 big players was only 1.7% of their market cap, whereas now the Mag 7 holds 4.2%, a 2.5 times improvement, with a notable mention to Amazon posted a percentage of 8.6%. So cash balances have improved, which is one positive indicator that the Mag 7 are looking stronger than their dot-com counterparts, as they have a more robust buffer against potential economic downturn. But it's the next 2 metrics I want to talk about that are really interesting and can give us more clues as to whether or not this is another bubble about to burst. The first is the forward price to earnings ratio. A price to earnings, or PE ratio, as you'll often see it referred to, measures a company's share price relative to its earnings per share. And what the forward PE ratio does, in essence, is use forecasted earnings rather than historical earnings to try and look ahead. Essentially, it's a measure that investors use to try and gauge a company's future earnings potential relative to its current stock price to see whether or not it looks like good value. Now, we should point out here that while the forward PE ratio is an interesting indicator, it has limitations. The main one being that we are relying on analysts' estimates for earnings, which of course can be inaccurate. It's hard to say what a good forward PE ratio figure actually is, as it differs from sector to sector. But generally speaking, the lower the figure, the better, as it may indicate a stock is undervalued relative to its future earnings potential. Now take a look at this. The dot-com bubble company's aggregate forward PE ratio looking ahead 24 months was 52. Whereas the Mag 7 is less than half this at 23.9, which is a significant difference. Take a look at Tesla though. Their forward PE ratio is in the realms of dot-com averages, worth noting. All this to say, it's another stick in the ground to suggest that, generally speaking, the Mag 7 are a very different collection of companies to those that went pop in 2000. But here's the most important measure of them all, net profit margin. How much of the revenue these companies are pulling in is actual profit as a percentage of their total revenue. For the dot-com era, this was 16%, with one entrant making no profit at all. The Mag 7 has an aggregate net profit margin of 28%, with the likes of Nvidia posting a figure of more than 50%. Is the rise of the Mag 7 the same as the dot-com bubble companies that went bang? No. The truth is, these tech Goliaths are not finger-in-the-air startups banking on pure speculation. They are actually structurally sound, profitable businesses with cash in the bank and have established pole positions in a global marketplace, not just the US. That being said, as an investor, you still shouldn't just be picking a handful of these 7 companies to invest in or to hang your retirement dreams onto. I'd go one step further than this and say you shouldn't be just investing in the S&P 500 alone, even though that does give you more diversification than handpicking a few American stocks, which is a good thing. You should diversify much wider than this still into global markets and potentially different asset classes if you want to manage your risk further. This is especially true if you've got one eye on retirement, because once you start drawing down on what you spent your whole life building up, it becomes much more important to make smart investment choices. If you're not sure what that looks like for you, I recommend you download our free retirement checklist in the description. It'll help you start asking yourself the right questions so you can find the best strategy for you. It's totally free. But if you're still not convinced about why you should look any further than a handful of tech stocks or the S&P 500, watch this to learn how the S&P 500 actually works and why it might be riskier than you think.